Hey, good morning, everybody. Welcome to another Tuesday morning call at Mortgage Coach. Every Tuesday, we're interviewing folks that I just think are amazing, whether it's a top producing loan officer. Actually, next Tuesday, I'm going to be interviewing Lori Richardson with Cornerstone Mortgage, or I'm interviewing an expert, a leader, a teacher, someone that I think can provide you with insight that will help you be more successful. Our mission is to help families make confident decisions, and we do that through helping the most successful mortgage professionals in the country deliver confident decisions. Here's a picture of Kelly Zitlow out of Scottsdale delivering value to a family, helping them with transparency and clarity, make the most informed decision. Here's a loan officer in Dallas, Texas, sitting down with a family, walking through their options in a coffee shop. But that's our mission. Help families make better decisions, help loan officers help families make better decisions. So today we have Tammy Butler. How you doing, Tammy?
I am doing great, Dave. Thanks for having me.
Good. Well, I'm looking forward to the conversation. In preparation for today's call, I went back and listened to the call. I can't remember if it was, I think it was January. Well, no, maybe it was December. It's been almost a year since we did a call, but we talked about millennials. We talked about mobile. We talked a little bit about compliance, and today we're going to talk a little bit more about how to turn fair lending and compliance into a competitive advantage. I'm looking forward to it.
Absolutely. And really, the big compliance work doesn't have to be something that's horrible and costs you money. It actually can be a way that you're paying attention to your business practices a little bit more and creating a lot more income, as many of my clients have seen. So I think it's going to be a great discussion about how to position compliance and the things that you need to do with compliance, but use that as an impetus to add to your bottom line as well.
Love it, love it. Also on the call, I asked Ken Perry to join us. I think everybody in the mortgage coach community knows Ken. He's going to help me just ask better questions, provide a little color along the way. How you doing, Ken?
I am doing great, Dave. Thanks for having me on, buddy.
All right. Well, hey, I look forward to what you bring to the table. So before we get into the heart of the topic, I do want to remind folks, if you missed last week's call with Daniel Harkavy, it was special. It was titled 6 Perspectives on Leadership. Daniel said a lot of things that were super smart, just netted out business planning. And this was probably my favorite quote of the day, where Daniel said, our leadership effectiveness will be determined by the quality of our decisions and the influence we have. I thought that was a powerful statement. I've thought about it several times since the call last week. One of his slides where he talked about defining your leadership, and just it all comes down to your decisions. He talked about the speed of decisions and the influence you have with your team. He went through, the 6 perspectives of leadership: current reality, long-term vision, strategic bets, the team, our customer, and your role. So if you did miss that call and you're a leader, it's a great call no matter where you're at in the leadership. If you're one of the top leaders in the country, I think you'll appreciate it. If you're growing as a leader, it's just a fantastic call and a must-watch for all Mortgage Coach members. So check that out. So let's get into this. I don't know how many years ago I met you for the first time, Tammy, but I know we reconnected when you were the leader, I think it was of compliance and fair lending with Optimal Blue, and just a fantastic champion. For those of you on the call that leverage our Optimal Blue integration, Tammy was just a tremendous champion within Optimal Blue to help make that a great relationship. And then, as I said, I interviewed you about a year ago, and we talked about why you should make your mobile device your #1 sales tool. And then, of course, Tammy, you've started your own business, Fair Lending Diversity. Super smart. You're helping a lot of large lenders. Before I just hand it off, if you wouldn't mind just telling us a little bit about yourself dating back to when you were an originator, and then I'll hand off the screen and we'll go through the keynote to kick things off.
Yeah, absolutely. Well, it's been a lot of years. And we all hate to admit that, right? But it's been over 30 years. And really, I fell into the business like most people. Long story short, I've done everything from post-closing, which is how I started in this industry, to closing, to a top-producing originator, to managing branches, regions, and companies. from the sales and marketing perspective. At one time, I was the largest training company in the industry. If you go way back, you'll probably remember publications like the Mortgage Generator or the Loan Officer Boot Camps and Processor Boot Camps. And so really how this all came to be, and I call this karma because I was the general originator who said, I don't need any stinking compliance, and why is this important, and I don't like rules, to really understanding where this was coming from when I developed some technologies that were picked up eventually by NeighborWorks America, La Raza, and NCRC. And these technologies became their lending platform, primarily for giving access to credit from all lending arenas into what we'll call the majority-minority markets. And that technology led me to Optimal Blue when they asked me to develop their analytics for fair lending. And I'll be honest with you, they taught me a lot, because if you were to ask me back then, do we treat anybody differently, my answer would have been, you know, listen, if I can get the loan in the door and I can get a commission on it, then why would I discriminate against somebody? And this is how it all kind of got started. And what they taught me, someone who thought that they knew quite a bit about the business, and going around to 200 facilities all over the country and working with the nonprofit counselors, is that we really have some work to do when it comes to understanding the impacts of fair and equitable treatment out there. So with that, the way that I approach any compliance is not to say you must do this and you must follow these rules, because that's just going to boomerang back into your face. But the way that you need to approach it is, okay, if I'm being asked to do this in my business, then really, what is it that I'm missing if I'm not doing this? And I think from the business profitability side, from cleaning up our business practices, from really understanding how our business is working, these compliance rules are teaching us some of that. Now, that's not to say that there aren't a whole bunch of rules out there that will just drive you crazy because they weren't thought through properly. But when it comes to things like fair and equitable treatment, I think that once we get into this material a little bit, you'll start to understand what I call the old school methodology. And the old school methodology was that when we were branch managers, or even when I was an originator, my branch manager, or when we were regional managers, the focus wasn't necessarily on recruiting as much as it was on making sure that the people that we recruited were successful and doing business properly, right? So we would self-test them. We would go in the field with them. We would go on sales calls with them. And we really had a very savvy knowledge about the people that were surrounding us and what they were doing that was and was not correct. You know, so in a nutshell, that's what my history has been and how I came to be here.
Well, every time I have a conversation with you, whether it's a public conversation like this or it's just one-on-one, I learn something. And every time I hear you talk about compliance or rules, I always, the way you do it helps improve productivity. So every loan officer that's on this call will give you a better career. It'll help you deliver a better level of service to your clients, and it will help you do that in a way that increases your business for 2017. So listen up, put your mobile phones away. Tammy's going to provide us a briefing. You know, there's a lot of mystery shopping going out there in the marketplace. She's going to talk about that a little bit. And then, you know, the second half to, you know, last third of the call, we'll do Q&A. Ken and I will ask Tammy questions, provide some color. I do want to remind everybody these slides are available in the handout. So for those of you that are going to ask me for these slides, they're already in the handout section. So you can download them and have them to check out after the call. With that said, Tammy, you know, positioning your business for success and with mystery shoppers, I'm looking forward to what you have to say.
All right, thank you, Dave. I appreciate it. Well, this really is about positioning your business for success more so than a compliance talk. because what we're going to do is we're going to talk about some best practices that, for my clients especially, have added dramatically to their bottom line. And as I go through this, I think you'll be able to piece together how these two can work together and accomplish the goal of meeting compliance standards, but also adding some dollars to your bottom line that you may not have thought about. I'm very passionate about this subject, which is why I specialize in it now. And I think it's because, you know, we really want to understand what's going on with our ever-evolving market as it relates to, you know, technologies, or as it relates to, you know, how people are shopping us. But the CFPB has made a profound change in our industry, and I certainly think we could all agree with that. And one of their latest techniques is this thing called mystery shopping. And they may call it something else, but long story short, mystery shopping is not privileged only to financial institutions. It goes on at every good business. This is how you test to see how people are being treated that enter your company. And that's an important aspect that I think we need to understand. We want to understand how our clients are being treated, and if they're being treated the way that we think they should. You know, for an example, I love Dave Ramsey's quote here. He says, you know, what you don't know can kill you. And that's a true statement, because what we don't know about our sales staff and what they're doing can actually kill our business. It can kill our business from several aspects. It can be that there was a missed opportunity. I'll give you a great example. My son is an originator, and someone called into him, and, you know, long story short, they wanted to buy a piece of property so they could put a tiny home on it. Now, nobody wanted to take that deal, and since he was junior originator, he got the phone call and he talked to the client and he began to explore. Well, even though we couldn't do the lot loan for the tiny home, the guy happened to have 2 investment properties that he needed to refinance. One was over $400,000 and one was $350,000. And so, you know, just a little bit of conversation with a client that you immediately had bias against that no one else wanted to take turned into 2 wonderful deals for him. So these are some of the techniques that we'll be talking about here. Okay, so the CFPB has gotten very active in mystery shopping. I reached out to Paul Lubin. Paul Lubin runs Lubin Research, and they are leading mystery shoppers for, you know, they do all the field work for mystery shopping. And he told me right now about 10% are mystery shop. 1 in 10 loan officers are mystery shop. But he also believes that the CFPB is ramping up that function. And as a result, I think it's important to see what they found in the last settlement. So this was a settlement.
Real quick, Tammy. And if I've bitten ahead, I apologize, but I want to make sure this point is clear. So first of all, there's different types of mystery shopping. One where a company themselves, you know, will be self-regulating. There's CFPB, and then there's, you know, there's consumer advocacy groups. Is that right? Are those the 3 types of mystery shoppers out there?
Yeah, those are the primary types. The self-testing, which would be your own company is testing you. Again, which is what we did when we were branch managers and regional managers. There's the regulators that are doing that, and we'll go into all these different examples. And of course, your competition for complaint purposes and whistleblowing, and also the consumer advocacy groups. So they're coming at you from all sides, and the better prepared you are, the better you can handle this.
Okay, good. Just wanted to understand that. I'll let you continue.
All right, thanks. So here's some recorded examples, and this came from the recent Bancorp South settlement. And when we read these things, we kind of cringe, right? I mean, this is in writing, and these were actually recorded during meetings. And as a result of that, now it's all over the news waves. And you probably have read some of this, but if you haven't, these could be some of the things that are happening in your shop and you're not even aware of it. Now, I just want to preface this with the fact that Bancorp South had these issues a year or two prior to these recordings. And so not addressing it meant that now we're really coming after you, and these are the things that were said a year or two after supposed big training. So manager instructed loan officers and processors under supervision that mortgage applicants from minorities and others viewed as protected class must be turned down in 21 days, and that borderline clients should be turned down quickly, while applications for white applicants are not subject to the shorter review period. So really what the manager said is, hey, you know what? If you get a minority borrower, we really want to make sure that you do something within 21 days and let's get this off of our books, versus giving the same treatment to the white applicant. When asked for an explanation of the race-based denial policy, which I just went through, the manager said, I think it's lawsuits, and we just dodged a really large bullet. And what they were referring to is the large bullet that they had dodged a couple of years prior to that. So that second bullet point is an example of an examiner asking one of your originators questions about why these things were said. And the response of a manager or loan officer then gets recorded into the books as to what they believe is the reason for that. A loan officer asked the manager whether loan officers should help marginally qualified applicants. And I think that this happens constantly, especially if you're part of a big team and you've got multiple loan officers working with you, right? You've got somebody that's marginally qualified. Do we take the time to help that client get up their credit score, change something a little bit so that they are more likely to be approved? Or do we, just kind of throw them against the wall? And if we're going to throw them against the wall, are we throwing them all back out to the wall or the market equally? And many times that's not the case. And sometimes when you're going through the bias training that should be required in every company, you start to realize that well, gosh, maybe I'm helping these marginally qualified applicants that, live in a really nice area and have a very nice loan amount. If I help them out a little bit, I can get that loan, versus another person who may have a seemingly more difficult loan. And so you just let that go back into, the black hole of where people go when we don't know what happens after they call us the first time. And that point, I just want to make very clear. There is lost opportunity in bullet point number 3. And one of the first things that I ask my CEOs that I'm working with, and two of my clients are in the top 10 nationally, is what happens to a client that calls in that is not ready to buy a home right now? And generally speaking, what I hear is silence. Or I'll hear, well, I don't know, I guess they go back out into the market. Well, there are actual incubation protocols that you can put in place that recapture that business back to your bottom line, that don't require your sales staff to be involved in it, that don't require, a whole bunch of time on your part, that simply requires the customer going into this incubation protocol where other people are able to assist them, give them some options, help them with their finances or whatever it is that they need to be helped with, and then that client gets back to you when they're ready. That's a huge lost opportunity, and I will put that in numbers for you right now. The lost opportunity that you're getting is that we did a beta with one branch, a small branch of one of the companies I'm working with. Talked to the branch manager. We estimated that there were about 500 people that they couldn't help on a yearly basis that weren't being tracked in any rhyme or reason. There was no incubation protocol. And that, after we did the numbers, meant that that branch was losing, and this is considering all the things you need to consider, like attrition and dropout and people that aren't interested and all of that. They were losing, one branch, $1.5 million of income. Now think about the amount of money that you spend in marketing and leads and all of that to only lose that because you didn't have one small protocol in place. Now if we move on to the next point, the loan officer commented they need to get their credit up, stop paying their damn bills late, you know, and everyone's laughing, ha, ha, ha. You know, these are the sorts of things. I'm not even going to read the last bullet point because I just can't even get this into my vocabulary. And you can read that yourself. But you know what? At the end of the day, if you hear this sort of thing going on, it's your ethical responsibility to say, you know what, guys, this kind of talk has no place in a business environment. If you want to do that, go home and do it. But in the business environment, you know, we're going to be a little bit more honorable with the people who are coming in. Okay? So let's go on to some of the basics. We'll talk about who they are. As Dave had asked earlier, you know, the regulators. The CFPB is very adamant about consumer protection. You know, former regulators that would oversee the banks and that sort of thing, I really didn't worry too much about that. But you have to remember the CFPB is consumer focused, and therefore their mystery shopping is increasing rapidly because they want to know what's going on in the field. And in my opinion, that's one of the areas that lenders are most vulnerable in, is the field. Because in operations, we can lock things down pretty well, right? We can, you know, lock things down in the LOS system, lock things down in our pricing engine. But really what happens in our consumer interaction with the client prior to the client even being known to the company is where there's a big void. And products like Mortgage Coach help lock down some of those controls. But the regulators kind of want to see what's going on there. So they're mystery shopping. The consumer advocacy groups are doing that. So you'll notice that consumer advocacy groups are out there. And if they see some bad practices or they hear some of their clients are getting ripped off, or, you know, they just hear around about that things are happening, they may choose at the national level to engage some of the mystery shopping services that occur in Washington, D.C. Your competition is out there doing that because they don't like the fact that, you know, you're not following best practices and they have to. And so, you know, kind of cleaning up things is some of their goals. Industry analysts, you'll see these with, you know, your universities and people that like to crunch numbers and talk about the, you know, your particular area or your city and what trends we see. They're looking at this data. And of course your company. So there are some companies out there self-testing. That's one of the questions the CFPB will ask in an ACOA exam. Are you self-testing? And if the answer is no, they're not going to exactly get good brownie points for that. So it's being done different ways. It used to be primarily done when HUD was doing it as the primary source. It used to be done primarily over the phone or in person. In person was the way it started. People would actually visit. But, you know, we've evolved since then. Not everybody visits us, right? So now it's being done over the phone. They're looking at your social media interaction. And if you haven't seen any of that, you may want to check that out. I happen to have quite a few originators that are connected on social media, and some of the things that get posted, it's very scary. They probably don't even know they're doing something wrong because it's the way they've always done it. And then, of course, texting and texting responses. That's the millennial way. They text people. So you may want to check out those sorts of things if you're thinking about assessing your group. And then how they use the information, of course, is for regulatory compliance. Are you treating people fairly and equally? And primarily it's called disparate treatment, meaning you're not treating people the same way or in a similar fashion. They use it as a basis for complaints to HUD or the CFPB. So a consumer advocacy group, as an example, will file a complaint with HUD or CFPB and say, this is what we found. They're using it for market knowledge and intel, and then, of course, market condition analysis. And market condition analysis is, you know, where are we having some of the higher priority issues. So the next thing I want to talk about is, you know, people say, well, you know, how do you know if you're going to be chosen for this? And really, the best way that I can describe this in my numerous conversations with the fair lending division at the CFPB is the first swipe that they look at is your HMDA data. And if you're familiar with the old HMDA data, we were pretty poor as an industry in getting correct data. Now we've doubled that data and have included quite a bit of pricing information. And the CFPB added that pricing information, not Dodd-Frank. And so when we look at that and say, okay, why are they interested in our pricing information? Well, the reason is they're going to dig down to the actual loan officer level, branch level, and they're going to be able to see from this new data exact patterns of practice in pricing disparity, closing cost disparity, all of the things that, you know, we weren't too concerned about a long time ago. So the practices of things like, you know, my loan officers all have different commission schedules, and therefore they all have different interest rates. And a consumer, depending on who they talk to, can get a different interest rate just by virtue of that. Those are the sorts of things they're going to be zoning in on in a hyper-focused mode. And the HMDA data is where they take that first swipe. So when the HMDA data is published, and it came out at the end of September this year, what happens is all of their economists in the CFPB begin doing two sorts of analysis. They're not only analyzing the lender and their patterns of practice, but they're also comparing the lender to their peers, because you can't be, you know, the one that's outstanding there. You have to be the one that's kind of in with everybody else versus the one that has a statistical anomaly, which is what they call it. And then just heard a couple of weeks ago when I was at the Fair Lending Colloquium, one of their senior economists mentioned that they're now using machine learning. So if you think of the IBM Watson, and the machine learning is basically learning lender practices when it comes to things like pricing disparity and closing cost disparity. So they take a look at that data deeply. And not to go too far down that, but what they do is if you stand out, you become targeted. That's it. Boom, you're there. That's the one that they put on their priority list. And then, of course, if you have a big impact on your general market, meaning you're a larger lender and you have a big impact on that market, and you also happen to be one that stands out as an anomaly, you can almost rest assured that you're on the top of the priority list for examination. Okay, so let's look at the science behind the shopping. So really what these testers are going in is they're looking for, do you treat clients fairly? And that's testing for disparate treatment. So if we have clients coming in and they're pretty similar in nature, are we treating them similarly? Financial profiles that they set up for the testers are similar. So you may see similar income, similar credit scores, similar debt scenarios. But generally the minority shopper is given just a slightly better profile. So, you know, maybe the non-minority shopper comes in and they have a 670 credit score, and the minority shopper comes in and they have a 680 credit score. So they may have a slightly better profile, or maybe they have a little bit less in debt, or just a little bit more in income. They're very similar, but they give the minority a distinct difference. So that's one way of detecting this pattern. The loan officer, they contact them the same way. So if it's through social media, through texting, through phone, in person, they're going to contact you the same way. They're going to use the exact communication technique. And they spend a lot of time training these shoppers on questions to ask, which are probing questions, and how to exactly document the response that was given. So things like, did you have to wait? Did they take your phone call? You know, I've heard of large originator shops where they've got, you know, the receptionist who is the firewall, and, you know, oh, you don't get through until you tell me how you were referred, sort of thing. You know, all that sort of thing can result in disparate treatment claims. They look at how you're going to follow up. So if they're using communication techniques with you for follow-up, they want to see how you're going to follow up. And if they can imagine that the minority shopper doesn't get any follow-up, but the non-minority shopper got follow-up, well, disparate treatment. And of course, they're going to ask the similar types of questions. So if you start to suspect that these are the same questions being asked and you've got clearly two different people that are fairly similar, you can almost assuredly expect that you have been shopped. And then what happens after the shopping is that they record this stuff in very finite detail. So I don't know if any of you have ever been through any of the surveys that people may run across in the malls where they're doing certain types of surveys, but every little detail is asked about. Now, what testers are unlikely to do, and I say unlikely because I never like to say never, simply because things advance and they may want to throw us a curveball once in a while. But they're unlikely to negotiate for better rate and cost, because what they want to see is, did you give me my best options? Did you tell the minority shopper that they could qualify for less just to give yourself a cushion, versus a non-minority shopper, which you maybe said they qualify for a little bit more, right? So they're looking at that sort of thing. They're unlikely to give you deep information like a social security number or birth date, although I can imagine now with technology that may be useful, where they're able to set up these scenarios online so you can even run a credit report. But we're not there yet. They're not doing that. They're probably not going to authorize a credit pool. They're probably not going to pay for any services, and they're definitely not going to state any preferences in loan options, because that's part of the testing. They want to see, what are you offering as far as program options for similarly situated clients? And so it's up to you to kind of say, here are your options. And again, that's where a software like Mortgage Coach just really covers you, because it's whatever you qualify for. Here you go. I'm just giving you your options, and I'm happy to answer any questions, but ultimately you need to decide that. And they're also not likely to indicate they're working with a real estate agent, because what they're testing for there is they want to see, are you working with a real estate agent? And if you're not, do you try to help someone find a real estate agent perhaps that doesn't have one, and then you don't necessarily offer that service to someone else? So those are things they're unlikely to do. And you can kind of piece together this puzzle in your head. So how are you going to protect you and your team? Well, the first thing that I'm going to say to you is that training is so very important. Not only the training, but also the role playing, really setting yourself up for success. All of the time that you may spend on training with things like sales and marketing, that's important to your business, and so is this sort of thing, because you don't want one loan officer or a few loan officers taking down your whole branch, your region, or your company. You want to test your branch employees. Whether you do it or someone else does it in your company, or you hire a company, you want to test those branch employees just to see what sort of results you're getting. Again, that whole team concept, which has become very popular over the last 10 years, you got to test these firewall employees. And the firewall employees are the people that get to the consumer first, whether it's a receptionist, a junior loan officer. Are they doing proper things to screen your clients well? And as I shared with you an example with my son earlier, those sorts of things you want to check, because if they're just kind of, I don't want to call that person back, I'm not going to do a lot loan with a tiny home on it. That's the sort of thing that can really get you caught up if you're not doing it the right way. You want to be present in your business, keep your ears open. Remember, there's a lot of lost opportunity here, and those incubation protocols are very important as to what you're going to do with the clients that you can't help at this time, but will likely go on to become a homeowner one day. Automate your proper follow-up controls. So again, Mortgage Coach helps you with that quite a bit. And then we're going to track the fallout clients and leads. Why did they not apply? Where did they go? Did the employees ever follow up with them? These sorts of things you want to take a look at, and I'm doing that very simply here today. But, that incubation protocol is a very strong procedure that you can put in place that doesn't take a lot of time and effort, but brings people back to you, and also cures for those pesky little fair lending issues. So with that, Dave, I am done with this overview of mystery shopping, and I'm happy to answer any questions.
Love it, love it. Hey, great overview. Questions have come in. I'm going to get to those questions. Ken Perry, I want to drive a bit of a conversation, and then I want you to kind of provide your color, ask some questions. If you guys can confirm that you can see my screen real quick first.
Yes, I see it.
Yeah, so first of all, I have put a link to Tammy's website, her LinkedIn profile, and some of the services that her and her organization offer for all of you branch managers, executives on the call. I can't recommend Tammy enough. I've worked with her for years. She is just a consummate professional, and she can add a lot of value in a lot of different ways. You know, I love it when she comes in and teaches clients. I mean, obviously, I've got a little bit of a horse in the race, and the fact that when a family gets into debt, you know, is a fee worksheet the best way to educate them? I say no. Graphs and charts, a mobile experience is a better way. But hopefully every mortgage coach on this call, you're starting to realize that delivering a fee worksheet to some families and graphs and charts to others, that's different. That's disparate. And one of the things that troubles me is I even find loan officers often, they'll give their family members and friends less of a quality service than they'll give a rate shopper, someone that's really grinding them. So, you know, one of our missions here at Mortgage Coach is to make it easy for you to deliver a mortgage coach experience to every family. And as I told you guys earlier in the call, Tammy, when she was at Optimal Blue, was one of our champions that helped make this integration happen. So while you may be on this call and not have access to a mortgage coach integration into Optimal Blue, you might be on this call and you have other technology. But I mean, this is an example of where we're making the workflow easier. You know, putting the mortgage coach tab in Optimal Blue so that a loan officer can just go, I want to present this option, click a button, and out comes this consistent way of delivering advice and value. Now, what I'm showing right now is just one example of one integration. And from my perspective, while integrating technology is important, it's only one piece of the puzzle. And even if you don't have a technology integration like the one we just showcased, you've got a team. You've got team. You have different people that have different levels of expertise, and every family has to get a consistent experience. It's not only good for compliance, it's good for business. So I wanted to, you know, showcase this integration because Tammy, you know, thank you for all the help while you were at Optimal Blue. You know, I'm showing some pictures now of great loan officers delivering great advice and delivering these consistent, transparent experiences at Mortgage Coach. But you know, we're one piece of the puzzle. There's a lot of different touch points, a lot of different ways that you need to deliver value and advice. Ken, I'm going to let you jump in. Any questions you have for Tammy, or just anything from your perspectives within this topic that might be helpful to the Mortgage Coach community?
Oh yeah, first of all, I might be the most excited one on this call listening to all of this because, I mean, you're speaking my language. I love when people talk about fair lending, and just the things that you brought up have been amazing. And one of the things that you said that I really loved is that firewall employee. I love that you talk about the first person to meet the client, because that is coming up in so many cases where they didn't even get to a loan officer because somebody along the way, you know, shut it down. So I love that you talked about that. One of the other things I've noted just recently, you're talking about, you know, winning more loans with fair lending, and if you look at what Fannie Mae has just done with Altera and with New American Funding, where they found people that are serving the Hispanic community, and they've pushed out programs specific to those companies where they're letting them in on product that other people aren't allowed to get to. It's just really going that way of it really is when you reach out to multiple communities, you get more product, which is fun to watch. Yeah, I think I would ask what we're running into as we do our continuing education all over the country. We're running into just that culture side of things where, you know, how do you, and Tammy, this is my question for you, how do you recommend changing a culture that's that way? You know, I think about one of those cases from last year out in Baltimore where they had a branch manager walking around saying, get me more ghetto loans, And again, you had the snickering and the giggling. How do you, with training and with those things, Tammy, how do you change a whole culture from being that good old boy network of ha 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 to taking this seriously?
Yeah, that's really a tough thing. That's really a tough thing, and I run across it every day myself. I will talk to people about what I do in a conference setting or environment, and they'll say, "Oh, we don't want to do those loans. Yeah, we're not interested in that." You get this stigma, and really, I think that culture starts at the top. I call it the big toe. The big toe has to say, this is important, this is what we're going to do. And if it's not taken seriously at the top, and the top could be at the top of your company, at the top of your region, at the top of your branch, then the entire culture of those surrounding them are unlikely to take that seriously as well. So if you're in an environment where the top people really could care less about this, don't understand the importance, really haven't explored it, beyond just their own little world of what they believe it to be, then at the end of the day, you're not going to get much change. And one of the, top producers in the country is a good friend of mine, and we were at a party one night, and he's like, "Hey, Tammy, how's it going with your Section 8 buyers?" So this is the sort of stigma that is out there. Of course, I had to slap them upside the head on that one, because it's not all Section 8 buyers. They're actually highly qualified people that are coming through the door. We had to have a conversation about that. We had a dialogue about why that was just an incredibly stupid thing to say, and what they're missing by not understanding this segment of the market. And you had brought up another point, Ken, that I think it's important to state, and that's this proliferation, I'll say, of minority-owned companies that are making their way into what we'll call the majority minority market. And that's a great game plan, but one has to be careful with that game plan as well, because there's something called reverse redlining. And redlining means I stay out of the area. Reverse redlining means I go into the area, but because I'm able to basically seize the opportunity, I can speak the language, I might look like the people, any of that, I take that opportunity as a way to increase my profit margin. And when compared to my peers, it looks like I'm charging higher interest rates and higher costs to majority minority markets as compared to non-minority markets, or compared to my peers. And so that's a great strategy, just one that lenders have to be very careful with if that's going to be their book of business.
Oh, what a great point. So if you serve that market, but you're the highest priced lender in the community, that would be taking advantage of that market and could really come back to bite you hard.
It could, because you're going to be compared to the other lenders in that market. And let's say that they say that they don't compare non-financial institutions to financial institutions, but in fact, when it comes to mortgage lines, they do. So let's say that the bankers in that area have an average interest rate one day, an average pricing of 3.5%, and you're consistently charging 4% because you feel like you're just better qualified to serve those people. That's not enough of a business justification in comparison to your peers. So it's not just about treating people within different communities fairly. It's about treating them fairly in comparison to your peers and their treatment, to make sure that you don't stick out as, this higher priced lender that's taking advantage of the fact that you can speak the language or you do look like the people.
Mm-hmm. I want to tie two things together that both of you said. And so Tammy and Dave, Tammy's talking a lot about secret shopping, and they're just doing it so much. I mean, CFPB, not to mention HUD, has funded more secret shoppers this year than they ever have. I want to paint a picture. If a secret shopper, you say one African-American borrower, one white borrower walk into a mortgage company, they're both secret shoppers. They want to know what the experience is. Loan officer sits down with the white borrower and goes, "Hey, great news! I've got this thing that I'll do. I'm gonna send you this report. It's got all of your options. It's got a video showing, exactly what the loans are and all of that. I'm gonna give you this great experience." And then the African American or Hispanic borrower the loan officer just goes, yeah, let me send you over, a couple worksheets. It is, I mean, that's definitely something I would be hugely concerned about, because your shoppers are going to go, oh, that's cool, so you gave the amazing tech experience to just your white borrowers. Like, it could backfire on you so much. And for those of you doing the Mortgage Coach reports for all your borrowers, awesome. Everybody deserves one. And why you would separate out who you give one to, it just blows me away. I have a friend who's using a Mortgage Coach loan officer right now, and he didn't send her one. And I called him up. I'm like, what are you thinking? I mean, like, this is the best information ever. And what was funny is I talked to my friend and I said, hey, did you get a Mortgage Coach report? Like, I was so excited to ask her if she had reviewed it yet. And she's like, I didn't get one. Everybody deserves one, and especially when you're dealing with that first-time home buyer, and especially when you deal with a lot of these younger borrowers, those millennial borrowers, they don't want the fees worksheet. They'll just get mad at you for sending it over. And so everybody deserves that experience, and it's definitely a risk to just choose, pick and choose which ones you're going to do that high-quality experience for, especially being that when you do a great, you have this great experience for them, you'll get more referrals and you'll get more business and you'll get a better borrower making a better decision. It makes no sense to just pick and choose.
Yeah, and that's a great point, Ken. And I think that when it comes to disparate treatment, really what you're being tested on is, let's say that I only use Mortgage Coach for my millennials because I think they're the only ones that are going to get it, right? Now, that's a bias that I have. And if I don't give it to someone who is older, or maybe someone that speaks a different language, now I have disparate treatment based on what they call a prohibited basis. So age, in the example of millennial versus non-millennial, race or ethnicity, in the example of, well, if I send it to them, they don't speak the language very well, so maybe they won't understand it. So, I'm not going to bother doing that. I think that your business controls have to be consistent when you're dealing with consumers, especially in today's world. Marketing has to be consistent. How you're approaching the consumer has to be consistent. What you're saying to them in social media and other venues has to be consistent. And if that consistency is not there, then what you're doing is you're setting yourself up for disparate treatment claims, and you don't want that. Hey, Dave, I see an HP12C. I thought I was the only one that ever used those anymore.
Yeah, right. Well, I mean, the thing I love about this photo, this is Jen Duplessis in the Washington, D.C. market, and she's got it all. She's got the old school paper, she's got the mobile app, she's ready to rock it with her HP12C. She's ready for, whatever she wants to do with the client. And I think, to the point you guys are both making, which is, music to our ears here at Mortgage Coach, is that every time a family gets into debt, let's deliver them a consistent experience. Let's not give one family fee worksheets and another family graphs and charts. It's not good business. It's costing you business from a conversion standpoint. It's costing you referrals, and it's creating risk. And then, the more consistent you are at delivering something amazing, the better you're going to get at it. If this is your culture, this is your team, this is the way we deliver advice, you win. So, folks, we did get a lot of questions. I'm going to knock out a few questions, and then Ken, be ready to ask another question or add another insight that you think is important. Les Berman said, I have a minimum loan size of $250K. I turn everyone down with smaller loans. Would that get me in trouble?
Potentially. What was that?
Sorry, that was me freaking out.
Yeah, potentially that can. And it's basically under disparate impact. And Luther Burbank is a good example of that in California, where they had the same thing. They had what they call a facially neutral policy, meaning everybody got treated the same way. But by virtue of that policy, it caused disparate impact on the community. And here's how they detect that. So what they do is they look at what's normal in your market. So your assessment area. For a bank, that may be your CRA assessment area. It may be an MSA. It's definitely an MSA for mortgage bankers. And they say, okay, so what's normal? And then what's normal in a normal home buyer and a normal loan amount in an area that may be considered underserved or majority minority? And if those don't line up to what your policies are from your pricing or your underwriting guidelines or loans you will or will not accept, then you're going to have something that's called disparate impact. And I'll give you a real life example here. So let's say that the average home buyer in a underserved area of my MSA is $150,000 with a 680 credit score. And I've never done any sort of analysis on that, and therefore, I don't know. Well, the first thing is if you're going to set up a rule, you need to do that analysis because you need empirical data for a business justification. So you say, all right, and yet my loan amount is $250,000 and a minimum credit score of 700. What the examiners are going to say is that without proper business justification, which is not your opinion, which is empirical data, that this would be a policy that causes disparate impact, and that's a really big issue that you would want to address. So the first thing I say to lenders that say we want to do it this way, I want a $250,000 loan, is we go into a market, we do an analysis of average home buyers in all parts of the market, and then we test to see if, in fact, that policy is going to cause any sort of disparate impact or disparate treatment to those clients. And if it does, then we have to say, all right, if you're going to keep this, you need a business justification backed by empirical data. And that generally is when they just decide to change the policy, because building empirical data is a very, very tough thing to do. It requires a lot of numbers people.
There you have it, folks. Not a good idea. And if you are going to do something like that, work with your company, your compliance team. As loan officers out there, you should not be creating those types of rules on your own or in a vacuum. So I've got another. Yeah, go ahead, Ken.
I'm sorry to interrupt. I just want to say Tammy just cemented her spot as my new compliance crush, because as soon as that question was asked, I was like, oh my gosh, Luther Burbank. I should talk about Luther Burbank. And then she goes straight to that big case. So yeah, Tammy, I'm a fan.
Thanks, Ken.
All right, guys. Well, hey, we've got about 8 minutes left, and we have more questions than we're going to be able to get to, but I want to get to a few more that I think are on the minds of other loan officers. So I'm going to pull out the questions that I have a feeling multiple people have asked. So here's a question. If I suspect I'm being mystery shopped, can I decline to work with that client and state that, they're not a good fit?
My advice would be absolutely not. Choosing and picking which clients you're going to work with is probably the first signal of disparate treatment. So you're going to choose to work with this client versus this client. Really, you should approach this with a very, what I call this almost robotic sort of way. I treat all clients the same. I will answer everyone's questions. I will communicate with them in the same pattern. I will do all the things that I normally do with anybody, with anyone that contacts me. Because if you choose not to work with them, or you find a way around them, or you ignore that particular phone call or any sort of follow-up, then you're setting yourself up for disparate treatment.
Okay.
Yeah, I would add to that. We always tell people get compliance involved if you feel like you've got a secret shopper, just because, it's going to make you nervous. That's just normal when you know you're being shopped. And so I always like when compliance can chime in. And just a quick thing, we had a client that was secret shopped. It was a nonprofit that was secret shopping as part of HUD's program. They had emailed our client and said that they were pregnant, going on maternity leave, and wanted to look at houses. His response was more of a, let's go ahead, and wait. And he was asking some questions and wanted to go back to work, just using the old guidelines before HUD had really blown up all of the things on what we were doing to people on maternity leave and what we were doing incorrectly. And his response ended up getting his company a pretty large settlement. They had to pay a large settlement over just his email response. And so it popped that their guidelines were wrong, their training was wrong. And you can always look for HUD, when a HUD secret shopping, you're always looking at what do they care about right now, and they went after disability. So now we're not asking for doctor letters. They went after the pregnancy ones. But just so you know, a lot of times these are coming in by email, and when you see something, just understand that's not a great place to talk about what you can and can't do. It's always good to get that borrower on the phone and get the full story, take everybody's application. Even if you think somebody's not going to qualify, you're not denying them at first level, because remember the ECOA says that if you get enough information to deliver some sort of approval or denial, and then you discourage them, you've actually denied an application. There's some work that needs to be done. So we always tell people, just bring them in and have that conversation, but never turn down somebody because you think they're a shopper. That is most likely going to turn out negative for you.
All right.
Yeah, I agree.
Here comes another question. I have asked this question to a number of different compliance folks. What is the proper response to an inquiry for a product you do not offer? For example, client calls and asks for 100% construction financing. You know you don't have 100% construction financing. What can you say?
Well, I think that's preparation, right? So if I know that somebody's going to call in periodically on random programs that may be, fairly normal to the area, the first thing I'm going to do and train the loan officers to do is who offers 100% construction financing in this area. So then the proper response would be, because one of the things they test for is if you are unable to help them, do you give them some sort of another option? And I may say, as an example, what my son did, he says, we don't do lot loans. However, I know several banks in the areas that will help you. And so, I'm happy to give you some names if you'd like that. Otherwise, you can certainly check with your own local bank. And generally speaking, the banks in the area are the ones that would offer lot types of financing for your particular issue, or your particular loan, not issue. So that is the way that I would handle it if I get the random phone calls of people that I just know that I'm not able to help and probably require a financial institution. I'd have in my back pocket some of the people at the financial institution who may be able to help them.
All right. So guys, I'm going to do one more question. Sorry for all the questions I have not been able to get to. Maybe we'll bring Tammy and Kim back because this seems to be a hot topic. But here's the last question. One of the concerns that I have as a person that speaks fluent Spanish and understands the Hispanic culture is that many loan officers do not speak the language and try to work with its customers. Don't you think we should have assigned loan officers for these customers, making sure that they understand the loan or even understand why they cannot qualify?
Well, I think there should be protocols in place for someone who has, what they call LEP, limited English proficiency, so that if someone calls in and there's limited English proficiency, meaning that the person is struggling with the language, it could be Spanish, it could be Polish, it could be, I'm here in Chicago, Polish is a big language, it could be any language, right? But if there is limited English proficiency and the loan officer who initially received a phone call doesn't necessarily feel that they're able to serve that customer, then what is the protocol for getting that to someone who would be able to serve them in a better way? And this should be a discussion at the branch level if this occurs more than once, right? What are we going to do if this happens, and what should be our protocols for this?
Great.
I could probably drop a bomb here at the end of this call, and that is HUD came out with a new interpretation of fair lending law that says basically the language spoken is a protected class based on the fact that it typically ties to a national origin, and national origin is covered. And so they're looking at not speaking Spanish as a major issue, or not speaking another language and having an option. So what Tammy just said is so right. Like, you need an option for them, or else it's like saying I won't do business because of your race. That's how HUD is now looking at language. So it's a giant thing, and the fact that they just came out with their announcement, I think it was just this year, tells you that that's probably going to go into their new secret shopping for 2017. Is they'll start looking at having somebody email and say, I only speak Spanish, what do you got? To see if you go, yeah, we don't do loans for your type. And that's not how you say it, but that's how it's read, and that's how it'll be listed in the enforcement order. So something that every company should be looking at now. How do we handle those people?
Yeah, and to be honest with you, part of the fair lending strategy is making sure that you have, community resources that you've already talked with, and say, hey, you know what, I'm here in Chicago. I have all sorts of different areas in Chicago that speak multiple different languages, and if I'm able to help them, what are the resources that I have available? Maybe home buying counselors, as an example, where we can work together and help this client out. I can explain things in my language. They can explain it in the language of the client, and we accomplish the whole. So there are multiple ways to do this depending on the size of your company. I realize not everybody is like, multi-billion-dollar company, but there are ways that even small companies can make this happen in a good way.
Absolutely. And do want to remind everybody on the call, Mortgage Coach is now in Spanish. So as you click on the report, there is a way to read every total cost analysis in Spanish. That's live and active in everyone's total cost analysis today. So folks, we are out of time. I want to remind everybody, we're getting into the holiday. I hope everybody has an amazing Thanksgiving. December 5th through December 16th, we're going to be doing a special, call it 10 Days to Rockstar. So what we think are some of the best, rockstar moves, shortcuts. This is what the best mortgage coaches do in today's market. We're going to teach you how to do everything that the best mortgage coaches do. So December 5th through December 16th, you can sign up for that. Also, I want to remind everybody, next Tuesday, I'm interviewing an amazing mortgage professional, Lori Richardson. This is actually a picture of her meeting with a realtor in her office, walking them through a mortgage coach total cost analysis experience. She's going to be sharing how she uses Mortgage Coach with her agents, how she uses it with families, how she does that in her office, what her goals are for 2017, and then what she does when they're not in their office. So don't miss next Tuesday's call, Tuesday, 9 o'clock Pacific, with Lori Richardson. As we wrap up today's call, I would love to know what you thought of today's call. So please let us know, did we wow you, surpass expectations, solid takeaways? If you're a guest on this call and you'd like to learn more about Mortgage Coach, click the last option. I'd like to get a demo and learn more. Also, want to urge everyone, whether you're a manager or a leader, you want to connect with Tammy after this call. Tammy, we did show a slide. I'm going to pop it up one more time. But what is your email and what is your preferred way, anybody who wants to reach out to you?
It really doesn't matter to me. My email is tammybutler@fairlendingdiversity.com, and my cell phone number is on there as well. So I accept phone calls, emails, text messages, however you want to communicate, it's fine with me.
Well, I am so grateful for your service to this industry. I've known you by reputation for decades, got to know you better in the last decade, and just grateful for the education that you bring to our industry. You really serve the industry in a special way. So thank you,
Well,
Tammy.
thank you. Yeah, thank you, and I sure do appreciate the opportunity to teach more people about fair lending. And thank you, Ken. It was great dialogue that we had. I'm very appreciative of that.
Ken Perry, thanks for jumping on this call last minute, brother. Any last words of wisdom, Mr. Ken Perry?
Yeah, I just think focus on the fact that you get to do more loans when you open up your business to more people, and it's just good business sense. And sometimes it's harder work, and you just do it. But at the end of the day, everybody can be a borrower, and everybody knows other people that can also be borrowers. So if we treat them all right, then it's just good business.
Right on. Have a great week, everybody. Have an amazing Thanksgiving holiday. Take care.